Hello guys, and glad to have you on board again today, as we will do on a regular basis now for these new seasons. So I've already started, but we're going to keep on going these ones. We still have the weekly updates that we do once a week, no matter what. For a longer time frame charts perspective, daily, weekly, and sometimes even monthly, that we do regularly on TradingView each and every Monday or so. And on a more shorter term perspective, we have a look at the shorter time frames, 4 hour down to 15 minutes at best. And we're having a look at the technical situation in which we could be settling for the week to come. So more of what to do on an intraday basis throughout each week, and we do this normally like if there are no specific timing, I will schedule these on Wednesday mornings. Of course, when there are technical situation visible right by Monday, I'll try to record them on Monday as well. So this is what we're doing today. We're having a look at charts only. We can definitely have a quick look at the economic calendar on those weekly reference timeframes. But this is that, well, I think this week is not really interesting in terms of market catalyst. We don't have big things like we had last week with the Jackson Hole Symposium and the PCE numbers. So I think numbers these weeks are numbers, but I don't think there are absolutely staggering numbers that might be driving the attention of this week. So more on a technical basis, we're going to have a look at the charts. Basically, we're going to just, as we always do, I don't give you tradable signals. I never will, I don't like that. This is not my job. My job is not to feed you, is to teach you how to feed yourselves correctly. So in that perspective, we're going to have a look at the big names, okay? So I'm going to take classical asset classes you care about, the cryptos, the stock market, and eventually the forex. And I'm always going to study just one asset, which seems to be the most liquid and technical situation. But of course, that doesn't mean you have to trade these only. You can derive all the technical analysis that I perform on your own personal preferred assets. So I'm going to have a look at Ethereum for the crypto reference, S&P for the stock market, and the DXY for dollars. But in that perspective, here's what we have. So we pay attention only to these time frame charts. So we're going to contextualize on the larger one, and we're going to start with the 4-hour chart on the Ethereum stuff. So as usual, remember that the noobs look at the market in a forecasting perspective, meaning that they read these things from left to right and then try to forecast what looks like the most probable. And that's exactly not what professionals are doing. Professionals are doing the radical opposite of it. And to plain it plain simple, if you learn my strategy, I always teach you one thing: don't ever pay attention to what happens in the left part of the chart. First, focus on the remaining last 5 boxes. Okay, so this is where the current market context is settled, and you need to filter your probabilities out of what happens now, and then eventually on some cases you're gonna have to scroll back in time to reject some probabilities. But first and foremost, we have a look at what happens now. And what happens now is a falling moving average with a rising context, and the moving average is inside the context. So this can be any more than a range in context. So you always know one thing: when you forecast that we're in a range, then you know that your risk reward ratios won't be staggering. So don't try to go for 1 to 5 risk reward ratios or stuff like that. We're not in trending context, so try to go easy on risk taking. You know that when you're taking 1% or 2% capital risk, you won't get any more than a 1 to 2 in returns or stuff like that. Okay, so that being said, we study the technical situation we're in for the latest 4 boxes. So we're in a range. We know that the risk rewards won't be very attractive, so don't go bold and don't try to go staggering returns on the risks you take. That's lesson 1. Lesson 2 is we look at the more in-depth technical that we can gather out of these remaining 5 boxes. So the more dominant technical structure that we have in here is this grayed out channels, which tells us one thing: that we've been lacking of volatility. The market breadth was very low, and in that perspective, that tells you one thing: that either you're going to have to decrease the risks you take, meaning that you certainly don't top up to 2% risk taking, because it normally means that the volatility will be impacting your price structures. So if you don't know how to handle volatility, which I teach you how to efficiently trade, but on the later stages of progression with the strategy, like I want you to understand price mechanics and supply and demand areas before trying to use volatility derivations of supply and demand. So in that perspective, understand that you can still trade your channels as usual, but just make sure that you have some spare gas for your stop losses. So take wider stop loss references or use the volatility as a reference for valuation. So in that perspective, if you use the latter, which I suggest is the most appropriate for those who know how to trade volatility, and you then will shift your supply and demand areas to be concentrated on three particular areas: the volatility average, which is the moving average, and the volatility boundaries, which will be the Bollinger Bands, or you can use other volatility averages, but I think this one is the most widely used. So if you use volatility, you'll know that in this very low volatile context, prices will always tend to trade to these three areas: the volatility boundaries, the upper and lower ones, and the moving average sitting in between. Okay? So we know that these are the technical areas in which you can trade, and you avoid trading when you are too far away from each one of these. So where we're currently sitting in terms of Ethereum is that we have two options. We're sitting below the moving average and far away from the lower Bollinger Band. So you know that the market will go for one of these two, and the question is which one. So if you are trading on a bullish perspective, then that means you're going to target the moving average and probably not the upper Bollinger Band in a shorter scale. Okay, it will take multiple weeks to get there, and we're not at that time any close to that. So the current option is retracing to the moving average and kind of ranging, which we've forecasted probably is the likeliest outcome. Are we going to keep on decreasing valuation slowly but steadily in a ranging context until we reach out to the lower volatility boundary? Okay, so that would be a simple assessment to me to understand what really this market is all about. The only thing that we can see and note is that we've tried to accelerate to the upside last week and we failed and rejected before even testing the moving average. So it feels to me like last week was a bit odd. I thought this would be the area in which the bears would have been traded out of this moving average, and we didn't really test it. So we're starting the week with a pretty negative stance, that's for sure. But the thing is that I don't think that's necessarily that bad, because you know one thing, in ranging structure more particularly, you never ever do any selling activity below 50% context, okay? So when we're on the lower 50% of a channel, this is where buy only, this is where sell only, okay? So you can't buy in the lower, in the top 50%, you can't sell in the lower 50%. So that tells us one thing. For those who are willing to sell, this is not going to be possible this week until we at least get above this level. And like we said, the speculative area is around the moving average. So for those who were willing to sell Ethereum, I think this week the sellable signals will be eventually worth it out of 1700 and above, where we'll find the moving average and things like that. For the bulls, though, because like we said, below 50%, there's only one thing you can do is to perform bullish actions. So in terms of bullish action, this is where the demand will be, the context for demand. So we're too far away from it. So either you wait for this and you will find signals, but remember what we stated earlier. That's the reason why I think this doesn't really worth the shot. So I wouldn't pay attention to this support channel for one reason. It would be absolutely 50-50 game in terms of moving average distance to the volatility boundary. Reason leading me to believe that if we were to go down there, that would be the sign of further deterioration within the next weeks until the Bollinger Bands gets to rise up again. And in that perspective, I think the technical tradable signal will eventually not be this week, but few weeks from now, eventually out of the merge. And that will be the sign of further down the road deterioration, eventually retesting the previous bottoms on Ethereum. So that could be one of the major forecasts in my personal opinion. We know the technical areas are going to be either this or that. And this week is going to be crucial. And I think it's a turning point this week because we have very few fundamental information coming from the economic calendar. So it's purely going to be a technical driven week. And this is the reason why I think it's particularly interesting. So like we stated, if you want to trade this week in terms of Ethereum, the only thing you can forecast is a move back to the moving average, and then it will be the bears' side to trade. And then we'll see if the bears have risk limitation to trade that moving average to the downside again. That would be sign of willingness to deteriorate prices further down the road and waiting for the moving average, for the volatility boundary to contract. Option number two, we get there are no bears, and we finally get to trade above that moving average. This is my personal favorite, of course, but these are the two scenarios. So we're at the turning point, and like I said, this trend channel in here, this context channel, in my personal opinion, doesn't worth it. Looking at the current context, the market is seeking for volatility demanded areas rather than channel-like, okay? So I would avoid trading in the context. because that would be just being in a 50-50 game from the demanded areas. So it's really either we start the week on a negative stance and we're going to quickly recover, not being bullish either, but just going back to the mean. And this is where the bears will have to play their cards. So if you play that anyway, remember that the strategy rules tells you one thing: you just can't trade without a context. So if you want to trade throughout this week, you know what to trade on because the context is 4 hour. But if you want to enter a trade, then you're going to have to trade in a context. And the context, therefore, is H1 time frame. This is where you're going to look for risk limitation to try trading in. Though these will be your target areas where you risk limit and eventually try to push a bit further. Though if we do risk limitation on H1 time frame to figure out the probability of seeing a trade throughout the week, same old stuff. We'll repeat the analysis out of the latest 4 boxes. Here we have a deteriorating moving average with a deteriorating price structure. So in we also have a volatility alert. So the same old story. In here, the supply and demand areas will be targeted toward averages and volatility boundaries. So we're already in a demanded area right by Monday, and therefore we look for risk limitations for those who are willing to get in. In terms of cyclical price activity, well, it's not that fancy, so I would say there's no need for an emergency call right now. Mostly being patient on Monday, eventually halfway through Tuesday as well. And depending on what we get, prices are sliding right now, so until they manage to reverse course by breaking the trend channel, I would say there's no risk to take for now. We also are trying to accelerate to the downside, and remember, when we try to accelerate is generally when we'll find the boundaries, okay? So the thing is that currently we're trying to accelerate right by Monday, and it tells me that we have very high likelihood of finding a bottom in the nearby area rather than anything else. We're already in demanded areas, so it's more a matter of how much risk limitation the bulls can take out of this market. And currently we do have the algorithm detecting some contexts, but the technical limitation in terms of signals are really not that great. So if you're willing to jump in the early stages of that week, then that mostly depends on whether we're going to get some better risk limitations. So that would be, for example, keep sliding until we get a better risk limitation in terms of signal, or if you're willing to go in without these technical signals, then the risks you take must be very, very limited, okay? So once again, not possible to take maximum risk for now in terms of bullish positioning. Of course, if you're in the bear camp, you're going to wait for the prices to retrace to the average in here, where you will find your speculative bearish areas. So this is where the bears will look for their signals to trade. This is where, of course, the bulls will have to risk limit if they're willing to get in. So this week's basically speculative area is in here. It's slowly sliding to the downside, just like the moving average is. And for the bears, the demand area is going to be right here, pure and simple. Okay, so that's for Ethereum. We're going to quickly do the same thing for Ethereum, for the S&P 500, and you're going to see that the technicals are very, very similar. To put it plain simple, this is what we have in the 4-hour chart: the same old thing, falling moving average, rising context, and lot of volatility alerts, or lack of volatility alerts. So the same old thing in here. The speculative areas are at the volatility boundaries. So we're already trading in an area in which there is very likely probability of finding some potential support, or at least this is an interesting area. Okay, this is where people will speculate. Then what is it going to end up with? Bullish or bearish reaction is a risk limitation perspective. You don't try to forecast the future. We just look for reasonable probabilities of trying one side or the other. Okay, so pick your side. If you think the market is bearish like crazy, then same old thing. Okay, this is where you want to sell the crap out of the S&P 500, or you want to break out the moving average, so you break out trade in this area. The second thing is the same as it is in Ethereum. You can't do that because you're trading below the 50% context, so there are no areas to sell in here. My personal opinion, if you're a bear in the stock market, you have to wait for a retracement to get better risk-reward ratios. Until then, well, there's nothing more to tell. So it is a bull matter in the early stages of that week, and the analysis we have in the S&P 500 is pretty much exactly the same as it is for Ethereum. Either the bears have total control and they're going to fuck it all up until we get to the lower volatility boundaries, but it's probably going to take a few weeks to get there, so there's nothing too fancy to forecast for this week as a probability to see this. So it's more in that perspective. There's nothing to do this week, and probably not the next as well, and probably a couple or 3 weeks from now we'll eventually get this volatility boundaries offerings. Until then, we're trading in an area in which only bulls can position themselves, and for now they have very limited risk limitations for this. Same old story as it is for Ethereum. We're trying to accelerate to the downside, so give it a second to plot. The cycles in here are a bit better, okay? We have the algorithm detecting reversal patterns in here as well. We're trading at volatility boundaries. The market is very violently trying to accelerate to the downside. So there are very likely probabilities of building bottoms in the nearby area. Just have to be cautious because in terms of technical risk limitation in signaling perspective, you've got absolutely nothing to deal with. So same old story to me. I think letting this market slide a bit on the early stages of that week is what is required. If you want to go in, I think the algorithms are detecting the context already, but you have to enter as little position sizing as possible because the risk limitation in terms of signaling is very weak or non-existent at all. So in that perspective, waiting or really going with a grain of salt seems to be like the rational option to me. In terms of dollar perspective, we're going to do the same thing as usual. The 4-hour boundaries, I think, have been dealt with last week when it comes to USD-JPY and stuff like that. We had some technical signals, which we've talked about last week. I personally have taken those trades. The big question is, well, do we going to get a double top? It's still the same old story when it comes to the dollar. Everyone's bullish for very weird reason, in my personal opinion. But the fact is that we were dealing with an opposite context and it fails to find some significant resistance. So I don't think this range is going to be broken, but for now we're dealing with resistant territory, which means whoever has been selling in these areas like I did, well, for now we are risk limiting, meaning that if the market pushes too far away, your stop losses are going to be triggered, and this is something that you need to account for. In my personal opinion, looking at the size of the trend channel, normally whoever traded the dollar must have wide stop losses, though normally right now, even if the market isn't sending good signals, that doesn't mean you failed your trade. It just means the market is in chaotic reaction and you're still waiting for either validation or invalidation. So invalidation is your stop loss, validation is going back to the trend channel. So I'm waiting for either of those two to play their games. I think the dollar is the missing piece in that current market. It's the one that's driving the narrative. Like the narrative is the dollar is so strong that it's fucking up every risk asset in the, down the road. So this is a narrative, like I said, we're in the top area of that range. So having narratives of everyone being bullish in the dollar is totally normal. That's what you will always see. In my personal opinion, we've reversed the context, so there's going to be profit takings more than bulls. Though in that perspective, I'm waiting as long as necessary for these trades to validate, and the only other option is taking my stop loss. For now, it's not done, so I'm currently just standing still. I see people just outrageously calling for bad trades or whatever. I haven't bad traded so far. I just think I had risk limitation, took the risks, and now I'm going to be seeing if whether or not that is a stop loss or a validation. Until then, I don't speak too much. It's really that thing, okay? So don't try to judge on the market. Don't try to follow the narratives. Just look at your charts and trade accordingly. Remember that we're not yet there to forecast the future or any such a thing. We're just there to find technical risk limitation and position capital when it is the most appropriate to do it. It's really that simple, and just rinse and repeat, rinse and repeat. These are strategies that pay over time if you repeat them several times. If you concentrate too much energy on a single trade or whatever, this is not how it works, okay? But when it comes of pure trading, just find the goddamn areas in which to trade, find a risk limitation, pick a side or pick no side. But anyway, trade when it's your time to trade. Monday is not the time for the bears to trade, it's the time for the bears to risk limit, because we're in areas in which the bulls might show up. For now, the signals for these bulls to show up, stock market and Ethereum's as an example, means that for now the bulls have no reason to rush in the markets. So it's more like a wait and see kind of approach. And that's exactly what I'm going to be doing earlier this week. Looking for technical signals, and if I show some, then I'm going to trigger some speculative trades on Ethereum and probably as well on the S&P 500. Even though the S&P, I've already positioned the trade earlier last week, I have a second trade to pull out when the signals will be there. Until then, trade safe. Look at this week's in a more technical stance rather than looking at the economic calendars and stuff like that. I think it's more of a technical driven week. It's been fucked up last week in the end by Jerome Powell's comments, but still that doesn't mean the market has a clear direction either. So we're in the top areas of range for dollars, so reversal is very much more likely, and the early signals we have right now are very, very bearish for the dollar. So don't try to follow the narratives, and even so, Friday has been very painful for those who anticipated the signals on Friday and before, like I did. But until then, this is no invalidation so far. The only thing we have is pure chaos. Remember that the market is a chaos machine that is creating as much indecision as possible. So right now people are lost, but the technicals speaks for themselves. I think we're in the top area. So I'd rather like not to follow the narrative. That being said, it's going to be it for today, and future will say if stop loss are reached out to, or if the market finally builds its market top, and then wait for the price to deteriorate, take your profits, and let the DOMs talk about it. Bye bye.